How should your mutual fund investing be in the year 26-27? It's a new financial year. It started on a very rocky note. Things look much better now. But can we do investing in mutual funds the same way we did in 24-25 or 25-26? That's the question which every investor needs to ask himself now. From what I see, investors have not changed either their investment strategy or their asset allocation or their portfolio positioning or their risk management over these 3 financial years. The last 2 years, traveling with an aggressive positioning on each of these aspects has actually not worked. Taking more risks has not delivered. But here is the bigger risk which you need to consider and carefully evaluate. In the current financial year, taking higher risks could even be punished. In the last 2 years, we were lucky not to be punished for taking too much risk in mutual funds. But this year, I believe that that may not hold good. We may be punished for taking too much risk, for investing at excessive valuation in specific themes, for choosing categories where the valuations are one standard deviation above their 10-year average. All this may not go unpunished. So, it is important that investors don't say last 2 years we didn't make money, so this year automatically we will make money. That's not an investment argument. Because when markets trend from excess valuation to high valuation, they will still come down to fair valuation and then undervaluation. So, the journey from where we are to undervaluation could well be made. If that journey is going to be made in your portfolio and that too in a significant part of your portfolio, you run the risk of seeing significant drawdowns even in your mutual fund investing. Where do I see this happen the most? I think small caps and mid caps still run the risk of seeing this happen. And unfortunately, the way portfolios are constructed in multi-cap as a category, this risk rises despite having a diversified portfolio. Because if your large cap is also not working and you are not positioned correctly in large cap, and anyway you get hit in small cap, which is nearly 35%, and your mid cap is also gradually trending down, your portfolio doesn't have any defense in it. In the flexi cap category, it's very product specific because fund managers have wide room to do whatever they want. So, you need to look at each fund very carefully and not maintain a category level stance. What does all this mean? It means that an investor needs to consciously create a defensive stance in his mutual fund investing for this financial year and the next one. Over this period, when he sees valuations coming into a zone of comfort, then he can take his risk up, and even then he should align the risk he is taking to his risk capacity and his risk profile. Right now, the biggest risk I am seeing with most investors is that they are taking risk above their risk capacity only because they believe that that is their ticket to higher returns. You didn't get returns at all in the last 1 or 2 years. You run the risk of negative returns in the next 1 or 2 if you do the same thing. That is precisely why you need to reposition yourself in your mutual fund investing, change your portfolio positioning, reduce your risk taking or moderate it at least, and keep a close watch on valuations and align your risk taking to valuations. This rally in the month of April is literally a godsend for people who did not do this through the financial year 25-26. And when you have an opportunity like this, which is a godsend, you must use it to lower your risk taking, to take your portfolio to a safer place and be on a higher ground, and to give yourself room to take risks whenever the market throws better opportunities at you. Investors have been complacent, and if I may say so, a tad overconfident in the last 2 financial years in their risk taking. My experience taught me one thing: such complacency, when extended beyond its shelf life and when extended way beyond what is bearable, tends to punish an investor. I have always been punished when I have been complacent, and the one thing that I would credit myself as a learning over decades and across cycles is my complacency level keeps going down and down and down with every market cycle. I don't want to be complacent, whether it is my own money or somebody else's money. That's one thing that I don't want, because the price of complacency is rising with every market cycle, because more people are complacent. The complacency plays out in ways which we never imagined in the past. The valuations tell you the story of this complacency, and when this complacency gets punished, it would be brutal. So, reducing this level of complacency in your portfolio, taking advantage of this April rally is the right thing to do, whether you are investing on your own or whether you are investing with the hand holding of a distributor or whether you are being guided by an advisor. It's not so much about how you are investing or who you are investing with, it's about what you choose as your portfolio positioning and how you fashion your risk taking in the current financial year. So, get it right and always stay safe. Investing will always give better outcomes to those who respect staying safe, at least before it is too late. Thank you for watching this video.